Well, good afternoon, everyone. Welcome to our Short Verticals webcast. It's been an interesting day in the market, hasn't it? Yeah, you got to hold on tight. I want to tell you that we're going to address some of your questions today. In fact, there's one request that several of you have, and that's to understand better the risk profile tool. So we're going to show you how to use that, especially those that are visual learners can really benefit from knowing how to use this tool. So we'll spend a little bit of time on that today. Now, I am joined in the chat by Brett Crowther. Brett's here to kind of have my back here. We'll both watch for questions, but as you have them, go ahead and chat in. If I can't get to it, Brett will get to that question for me. Okay, we definitely want your questions to be answered. If you're listening to this on the recording, and I know lots of you are, go ahead and put your question in the comments section of YouTube. I'll go back and review those so you can get your questions answered very quickly as well. Now, I hope you're following us, coaches, on X. My handle is Connie Hill CS, and I'll post educational content out in my X throughout the trading day, things that I might have noticed or found interesting that I think you might like. I like to share that with you as well. Now, we're in some real volatile times, so we're going to take advantage of that opportunity as we discuss short verticals. Let's go through our disclosures, and I will lay out our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and education. Don't consider it a recommendation. We will be using the Paper Money software application. It's for educational purposes as well. I think it's a fantastic tool as you're trying to figure out rules for different strategies. Man, that's a great place to practice that, especially say your short verticals. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. One thing that's very particular, has particular importance to our class here is short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And that is something that Paper Money handles differently than the live market. Paper Money won't assign you early, but you need to know absolutely the live market can and will do that to you. Want to just headline some workshops that we're having coming up. Those of you that maybe can get to one of these places fairly easily, maybe, you know, Denver's not your backyard, but it's a nice little jaunt for you to get there. You'll really thank me, all right, if you go ahead and sign up for one of these workshops. They're live, they're free. We are so incredibly nice to you. We feed you, and you come away with a better understanding of technical analysis and option strategies. So I'm just going to encourage you to sign up for one of those if you're at all interested, because they fill up pretty quickly. Now, I always like to, as far as our agenda goes, talk a little bit about short verticals. We have new people joining us all the time, maybe some new people that are familiar with the strategy, but maybe not in too deep. And I want you to be able to follow along with us. But hopefully you've already gone through the class of getting started with options and you've reviewed how those short verticals work. We will talk about some different examples here today. Some of them are example trades. Some of them are going to be new trades that we're going to do, and have quite a full agenda of different stocks for us to look at. So let's just talk a little bit about what short verticals are. Basically, we're going to use two strike prices. One we're going to sell and one we're going to buy. And so the one that we sell, we know we have a potential obligation to sell of the stock to somebody else at whatever our strike price is. And as a buyer of a call option, we have the right, but it's not the obligation to buy the underlying stock at whatever our strike price is there. And by doing that, structuring a trade that way, we have some defined risk. We know exactly what our risk could possibly be, and we can position size to that. Okay, this is a bearish strategy, which is so appropriate for the market that we're in right now. About 2 weeks ago, maybe 3 weeks ago, we created together as a class a short called verticals watch list. And we are using that watch list for all of the trades that we're going to be looking at here today. If you missed that class, I'll put a link in the YouTube information so that if you wanted to go and create that watch list, you could do that as well. We'll be updating it. Maybe in 2 or 3 weeks, we'll update that list. But we're looking for short call verticals, which is all we're going to focus on here today. We want the trend to be either bearish or neutral. We're always looking for stocks with higher trading volumes because that typically leads us to stocks that have higher open interest, which means lots of contracts are out there being traded. And when we see all of those, there is a tendency for us to have what's called a tight bid-ask spread, which means there's not much price difference between the ask and the bid prices on that. And so our watch list that we created addresses those areas that are stocks that we don't mind trading on, doing some short verticals. Now, timing-wise, well, timing-wise is timing on any option strategy is important. We typically are looking for something that's just breaking below support right now. It could be a diagonal resistance or support or a bear flag pattern. In fact, we're going to see some bear flag patterns today. Or something some traders look for is a close below the low of the high day. And that's as you're looking at your candles. So any one of those could be appropriate as far as an entry signal goes. Now let's go out to my Thinkorswim. And we're going to start out here. You guys have probably been paying attention to what's going on in the market today, unless you just barely jumped on or your head's been in the sand or asleep or something. Yeah, we've been having a major bearish day in the market, reaction to the tariffs that were announced last night after the market closed. So we've got the SPX here, and we can see, man, that had a pretty decent gap down. It had been holding this 5,500 line, but today definitely gapping down, and we can see the rise in the implied volatility. Let's just look at the NDX real quick. It looks similar to the SPX, and our watch list primarily from S&P 500 stocks and NASDAQ 100 stocks. So we're typically liking to take a look at them. Now, this had a similar type thing going on in terms of, maybe there was a flag type pattern going on here, and it had been consolidated, and then it broke below there, and then just tried to rally up, but ran into maybe some diagonal resistance here, and then today, of course, gapping down. Now, this 18,745-ish line is some old support. So it could be that maybe the market finds some support there, or you might look at this and go, it's kind of a ways down. Maybe it's going to have to look for the next level of support down, which maybe is about 18,353. Now, the VIX is off its high points of today. It had moved up rapidly up to this area where it's higher volatility. What does that do to the market? Well, for option premiums, what it means is they get a little bit more expensive. Now, if we're trying to buy options, that might prove as a hindrance to us. If we're selling options, sometimes that gives us a little bit more cushion in what we might be selling because we know the options are expensive right now. Now, the watch list, Richard, I'll show you that watch list. We'll look at it here. I'm not allowed to share it with you, but you can go out and create it yourself. I'll show you some of it here. And all I did with it, we're going to use this list for bullish and bearish trades, okay? And I just sorted it today by the downside, right? Who's lost the most and going in descending order. If I scroll all the way to the bottom, we'll see actually some stocks that are up today. We didn't have too many rays of sunshine, but there were little pockets of stocks that were actually bullish today. Okay, so that is where that watch list is. Again, I cannot share the link with you, but I can tell you, in fact, I'll show you where the class is because we did it right at the very beginning of this class. If we come over here to the Trader Talks channel, which I hope you're a subscriber to, it just makes finding our content so much easier. If you haven't subscribed yet, just click on that little link bottom right hand corner to allow yourself to subscribe. Just do it once. If you do it more than once, the next time it'll unsubscribe you. Now, to find our class watch list, click on the playlist here. We're going to come down about 7 rows, and then we're going to see the short verticals playlist here. I called it a watch list. It really meant like a playlist. I'm just going to bring this up. We're going to pause this little video. Good afternoon, everyone. Welcome to and we're going to come over here to where it says how to create a short verticals watch list. Okay, that is the video right there, the one in pink. And at the beginning of the video, we'll go through that process of creating this decent sized watch list that we're going to be using. All right, so appreciate the question there. Let's see here real quickly. Let's go back. Let's go back to Thinkorswim here. Wanted to start out by looking at a couple of potential trades. And then we're going to spend some time looking at what is going on with some of our trades right now. It's a very educational time, all right, that we're seeing in the marketplace that just really plays well into short call verticals, short put verticals, just this idea of selling premium. Now, the first one we're going to take a look at here, and I should say, it might seem like the letter A is our sponsor here today because I have several stocks that start with the letter A, but also we're seeing some bear calls. So this is AppLovin. This is a tech stock, and it had a nice run up, but you can see what kind of a correction it's had from this peak at 525 to where it's sitting right now at 260. I mean, that is quite the haircut that it's had. And if we look at it a little bit closer to what's going on right now, we can see what? We can see a flagpole. We can see the consolidating flag. And then today we see the breakout of the flag. So some traders like to use that as an entry signal. Some traders might even use this to help give them a target that they're intending or want to see the stock go to. If I duplicate that drawing and I come and set it down here and put it, I can put it in one or two places. I could put it just on where it's breaking out. For a more conservative target, what we might do is just go ahead and place this right at the back part of the flag formation. And then this might say, oh, we've got maybe a little bit of a target down to about maybe 181, 182, something in that area. Now, for our purposes, we're not going to set up a target specifically based on the flag pattern, but some people really like to use that as an entry into some bearish plays. So let's come over here. Let's go to the trade tab. And what's nice about this is it does have some weekly options available to it. However, as I was hunting in it, they weren't quite as liquid as what I would like to see at the strike prices that were going to be most useful to us. So, many times traders like to sell between 20 to 40 days worth of time. The ones in May that are the monthlies have about 43 days, so it fits in that general window. Sometimes we have to go a little bit longer than 40 days. But what I love to see here is this open interest. See all these contracts? That's the kind of thing we want to see, so that there are other contracts that are being exchanged. It makes it easier for us to get in and out of. And so when we're talking about this watch list, okay, yeah, that's absolutely what we want to see, is that liquidity. The strike prices I was looking to here, many times traders will kind of target a 30-something delta, sometimes a high 20-something delta. People that maybe want to skew it to a bigger return with a lower probability might look at a 40-something delta. The one we were going to use here, let's see if this still looks like it's appropriate. We are looking at, let's see here, the 30 delta here is 340. And so let's just kind of size this up, see if it still looks appropriate here. And so we're going to say sell. We're going to say a vertical here. And that's actually a really nice credit, which means it's really a fairly high return for us. And notice here, the implied volatility priced into these options. Look at this, 116%. Up here a little bit higher in the weeklies, we've got 126 and so forth. So there's a lot of implied volatility in the premium. That gives us the opportunity to maybe even go out of the money a little bit further and still get the kind of return we're looking for. So let's do this. Maybe let's go down here to the 350. Let's try 350, 360, because it's moved a little bit on me since let's get that over here to the sell side. And with this one, maybe about $1.70 credit. That's still a really healthy premium. What kind of a return would that give us? I'm just going to kind of lock that in. And I'm going to delete the first one we brought up here because we're not going to use it. We're going to go out of the money a little bit further. And let's bring our handy dandy calculator up in a $10 wide spread. We're going to take the difference in the strike prices and minus what our credit is to know what our max theoretical loss is. That's going to be $8.25. So let's run some numbers here. Okay. Let's suppose we have $1.75. Divide that by 825, our maximum theoretical max loss. That actually turns out only to be about 21%. We may have to go back up to this one. I was thinking it was going to be a $5 widespread at that credit, but it's really a $10 widespread. Let's come up to the one I had here originally. And we're just going to do sell vertical. We'll come back here and we'll get rid of this one. Let's see if we have something a little bit better than 20%. It should be, right? And so come on back here. Let's lock it in at $2. Okay, so if we have $2 divided by 8, that's going to give us a 25% return. Some people might be satisfied with that. Some people might go, you know, let's go a little bit higher up or lower in the strike price, but a higher delta. So maybe we have a more targeted concern or targeted area. Let's go here. Let's go 320, 330. And I'll get rid of this one. And 215. Okay. We're doing 215 divided by what? 785. Then that gets us a little bit closer to, say, a 27%. Now, some might be satisfied with that, some might not. Now, one of the things a couple of you wanted to know is, how do I use the risk profile better? How do I, what can we do with it that maybe gives us more information than just, for example, the probability that the option would expire out of the money? Right now, this one's sitting at about 76%, okay? One thing I want to point out to you is the spread is a little bit wider than maybe what we might want to see. It's still less than 10%, but on volatile days, one thing you're going to notice is the bid-ask spread kind of widens out a little bit wider than maybe what it normally is. We're seeing that reflected in these option contracts here. Teresa says, shouldn't the credit be a minimum of a third of the spread width? You could use that if you wanted to. Absolutely, you could. We haven't kind of enforced that per se in this particular class, but you certainly could. If you've got that as one of your rules, absolutely. Okay. And in that case, then you might want a little bit juicier credit, right? So you might need to go up here to maybe sell a 39 or a 43 delta so that it meets that criteria for you. Now we're going to select on this. We're just going to say analyze trade. And as we do so, let's get rid of one of these. There we go. We'll just do one contract for now for our analysis. And let's maybe point out what's going on here. Now, hopefully you've seen this before. If you haven't seen it before, just know it takes a few repetitions before you feel super comfortable with it. Remember, I needed to see lots of examples when I first learned this risk profile. So let's just kind of orient you. Over here on the left is basically our money. Anything above zero is profitable. Anything lower than this zero line means that it's losing money. Down here at the bottom, we have the different prices that the stock could go to. Okay, so anywhere from 180 to whatever else is showing on the scale, right? Up to 450. Now, there are two lines here. One is purple and one is turquoise. And what the turquoise looking line, this one here, it's telling us what our profit and loss is at options expiration. And we're going to have to go through, and it's actually in here, the options expiration date up here in the upper right-hand corner. This purple line really is tracking our profit and loss as of a certain date. Now, the date in here, we're going to have to go adjust that. It's a little bit behind schedule. Well, no, today actually is the 4th or the 3rd, isn't it? So that's as of today, but we can always go in and play with that. And we can say, well, what would it look like in 2 weeks? Now, let's get rid of these drawings here. And I want to point out, if you put your mouse anywhere along here, and we can stretch this out a little bit if we want to see a little bit more of kind of this gradual profitability line. Up here at the top is our max theoretical gain, 245, and it's per contract series. It's not going to get better than that. That is fixed. We go into the trade knowing that. This line down here basically slopes from our max gain down here to our max loss. We will not lose any more than 755. That's it. It's risk defined. We know exactly what that's going to be. And then along this line, we have partial profitability and partial loss. Okay, so this landed line along here is that portion of the loss, not an absolute max. And then this little area here from the 0 up to the apex here, that is our partial gain. And then once it gets up here to be flat, it's not going to gain any more than that. So visually, it kind of can give us a little bit of an idea beyond saying, hey, our option has the probability of expiring out of the money at X%. We're kind of seeing it visually a little bit. Now, not everybody is going to, I'm going to say, fall in love with this. There are some people that certainly might, okay? And for certain learners, and these are really visual people, and that's what's, a couple of you have said in the survey, you said, I'm really visual and it really would help me to be able to learn this a little bit better. Now I'm going to move this over a little bit. If you want to move it over a little bit, you just kind of click and pan. I want you to see this entire gray area because I want you to see and tell you what it means. We've got some gray shaded area in here. This gray shaded area represents a standard deviation from the mean. And you're like, whoa, that goes back to statistics. I haven't had statistics for a long time. I'm going to just draw a little picture here for you. But suppose we had a bell-shaped curve. Then we have the middle part, which we call the mean. And pretend this is drawn perfectly, okay? I'm not the best artist. In any case, we have our mean, and then we have what's called a standard deviation from the mean, which is basically on either side of the line. It might come down maybe something like that. And what that means is that it is going to incorporate 68.27% of the data points that the stock price could go. And so generally, we're looking for that one standard deviation from the mean. Now, if we go out 2 standard deviations, this is kind of maybe looking a little bit more like where those 2 lines go. And then that represents roughly about 95% of the data points of where the stock could go. But generally, we're just kind of looking, for that one standard deviation. So the gray area represents the one standard deviation from the mean. All right. That might be a little bit too much for those of you that are just kind of maybe seeing this for the first time, but those of you that maybe have seen it, maybe as you go and see different examples of it, it'll help you understand what it's trying to show us and allowing us to do. Let's do this here. Let's go back. We're going to go back to our trade tab. We won't do this on every one of our trades today, but I do want to expose you to it, and we'll look at it from time to time because it's very appropriate in a short verticals class. And maybe one thing I should show you real quickly before we move on is you can change some of these data points. I told you this is the options expiration. Down here is today or another day that you choose. And if you click on this calendar, you could say, oh, what would this look like maybe by, say, May 2nd, right? And you can change the date to May 2nd. And typically our points or our percentages at the top typically adjust. Now this would be after the expiration day, so I guess I shouldn't really go back that far. Maybe would go to the day before options expiration. That might make a little bit more sense. And then we can see up here some percentages. They're kind of light. This side says 14.36%, which means from this dotted line, which is our break even, over to the right, there's about a 14% chance that the price is going to fall in that range. Now I'm going to reset these slices to our break-even point. Now it looks a little bit better here. So from this point to the left, this is saying from that dotted line, there's about a 99% chance of the price of the stock being between where our break even is here at 322. This is saying 70. It's pretty close. It should be like 322.65. Okay, just a few pennies off. But it kind of gives you a visual representation. And then when you're in a trade, you can go and check the progress of it. Okay, we'll do that in one of our follow-up trades here. All right, let's go back to the trade tab and let's get this trade underway. Okay, it is unselected. Okay, 275. We'll stick with 275 here as our credit. We'll only do one contract because we want a position size so that we're losing no more than $1,500 per contract. And it's getting a little too tight there if we do two contracts. So we're just going to do the one contract. I'm going to do a first trigger sequence, and we're going to put in an opposite order. And something that we've done a lot of in this class is said, you know, if we get X% of this spread, we're happy. We're going to get out of the trade and move on. So, you know, you get to decide what this percent is, and it may vary from trade to trade, or you might end up saying, you know, usually X% works for me, whether it's 60, 70, 80, 75, you kind of get it to determine that. For our class, one that we use frequently is 70%. So let's put in our 270 of premium, and we're going to multiply that by 0.3% because when we've got 70, only 30% is left. And so we'd say, great, let's go buy this back at about 81 cents and not worry about tiny little pennies that we want to pick up, right? We just are looking to bring in the chunk. We'll make this good till canceled, and then it'll sit out there to let Thinkorswim do the work as far as catching it. You don't have to sit there and babysit and try to catch it when you get something in that neighborhood. All right, let's go ahead and hit confirm and send because this is bearish. We're going to put it in our verticals, our short bear verticals bucket. Let's go ahead and hit send here. And we'll get expected to be filled here pretty quick. All right, next up, take a look at another stock here. I told you the letter A was sponsoring some things here. I'm just going to see maybe which ones look the best still. Here's AMD. We can see what's been going on with it. Semiconductor stock, right? It too had this bear flag. And it was interesting because it looked like maybe it was starting to gain some momentum here. Kind of got up to, you know, this 113-ish area, but then broke down, formed a lower low, and we've got this bear flag here. And again, it's breaking out of it. We're not going to use the height of the flag pattern, that flag pole. We're not going to use that for our target. We'll go ahead and use the percentage methodology. But again, some people might like to use that as an entry. Now, one thing that you may notice here, I've got this white line because if we go back, like say to a 2-year chart, we might be seeing some support in this area. If somebody were not trading it as a flag pattern, they might be more cognizant of that. They might go, I want to make sure it breaks down below the support area. But when we're trading price patterns, we're sticking to the rules of that, in this case, the flag pattern for determining entries and exits. Okay, so we're getting in here based on that. Let's bring that back to, say, a 3-month chart. And so we're going to play it based on the flag rules, which are typically, we're going to, if this stock reverses and heads back into the flag consolidation, we'd call it a false breakout. We say, it's not following through with what we thought it was going to do. Okay. And we'll manage that manually versus putting in a hard stop, although some people might prefer to put in a hard stop. But the expectation in here is it could reverse a little bit. It could come up, or it could go sideways for us, or maybe it could drop, making the flag pole, the new flag pole. Hopefully it would be a kind of a steep little drop for us that we might expect. Now let's go ahead. Let's see what might be appropriate here on this particular one. I was looking at these April 25s on this. The reason I was looking at the April 25s is it gives us some time in the shorter area of the window where time decays more rapidly. and we've got a lot of open interest. So I was looking at these 22 days worth of time left as one we're going to target here. And this one I was looking at 103, 104. Let's see. It was interesting because I was able to go out a little further on the delta here than typically what we might expect, but I think it's dropped a little bit more. So I think what I'll do here, let's start out at the 101. Let's go 101, 102. And we will sell this vertical. And it's going to give us about a 30-cent return. So we'll say we're willing to risk 70 cents in order to gain 30 cents. Right now, if we look at the probability of this option expiring out of the money, which is what we want, it's about 70% right here. So many traders, if it's 60 or higher, they feel comfortable with that. Knowing that option premiums are a little bit more expensive might lead some of you to say, well, maybe I would go for the 30 delta or the 27 delta. And you could very well do that, right? Totally within bounds of what might be considered normal, right? But let's see what our percent return would be here. If we say, all right, we've got 31 cents divided by now 69 cents, that's about a 44% return, which that's why some people might back off and choose a little bit lower delta here. For our purposes here today, we're going to leave it. And if we are risking, in this case, about 69 cents of our $1,500 that we're willing to risk in this portfolio, and if we divide that by our 69, let's see how many contracts we could do. 21. That's a lot of contracts, isn't it? Let's just go an even 20 on this one, okay? Now, this might be appropriate. Having a $1 wide spread might be helpful to those of you that have smaller accounts and you're like, yeah, I can only risk $200 a trade. That's when it's kind of helpful to be able to see these $1 strike increments as long as you have sufficient open interest. Now, looking at this, I'm not seeing maybe as many contracts at the 101s as I would like to see. This one here at 227 with some volume today and 449 is actually a little bit nicer. So I'm going to scale back on our number of contracts here. Or some of you may say, I'm just going to switch over contracts and choose some that do actually have a little bit more liquidity like I was initially planning to do. So let's do this. Let's do, in this case, let's just go with 6 contracts. Because of the liquidity here not being as generous as what I'd like to see, okay? Bill says, yeah, 20 contracts is almost a third of open interest. That's true on this one. So thanks for doing the math there for me. Appreciate that. Let's do this. Man, that just keeps growing here. Okay, I'm going to switch ponies on us, guys, and I'm going to go a little bit, one strike out of the money. Let's make sure that still is about a 30-something% return, probably in the neighborhood of about 34, 35. We're going to go with these strikes and be with some numbers that are a little bit more plentiful. All right, we'll go ahead. We'll do 10 contracts here. And we'll make it a first trigger sequential. We're going to do the same thing. When we get a chunk of this, we are going to say, go ahead, buy it back. Okay. Let's lock it in here at 28 cents. I know it's jumping around a little bit, but if we have a credit of 28 cents and we are saying we're willing to risk $50, well, we decided to do the 10 contracts. But when we get a chunk of this, let's again use the 70%. We're going to multiply it by 0.3, right? 30% left when we've got 70% of it. And let's see here. That says go buy it back at 9 cents. Okay, so we're going to do it. Going to go ahead. We're going to make this good till canceled. We don't care when it happens. We'll just have Thinkorswim processes execute it for us, right? Have our order sitting in there. And let's go ahead and throw it in the bearish bucket here. I'll go ahead and hit send. All right. Now I want to take a little bit of time to talk about some of our current trades and trades that actually hit their targets today. So I was looking over here to the monitor tab. We've got a bucket here for our short verticals that are bullish and our short verticals that are bearish. Now, interestingly enough, and this actually surprised me, our bullish ones are actually having some green today. In fact, they made some decent progress for us today. As the market's been falling, there are little pockets that maybe transitions are going to, okay? And what we're seeing is maybe things that maybe seem a little bit more defensive, like I'm not going to get rid of my cell phone, and you probably aren't either. We've got T-Mobile and Verizon there, and we're kind of seeing a shift of money. So we're going to let these work, okay? We have 14 days left on each of them, so they're working. We've got our buyback orders, our exit orders. We've got them in place. We're going to let it work for us. Now, let's take a quick look at VST. VST was one in our bearish bucket, and you can see we're not in it anymore. We're out of it. Let's just take a quick look at the chart and see what happened here. We've been in this trade for about 3 weeks here. We got in on March 6th, okay? And initially it dropped down for us. It was a bear call as well. We had seen this bear flag forming, and it dropped out of the bear flag. But it came up and kind of got up into this area where sometimes you might feel a little uncomfortable. We wanted it to stay below the 130 strike price. And it went up above it for a little bit, but we still had plenty of time. But it dropped down and had that kind of, notice that bear flag pattern here. And today dropped out of it, went and hit our exit. Got us out at whatever our chunk was that we were going to be happy to keep. We come over here and just look at it real quick. We had said, hey, go and buy it back for 30. If it gets to 31 cents, go buy it back. We're going to be happy. And it filled us at 30. So we got a 1 penny greater than what we expected. But we didn't have to sit there and try to catch it. We just let our exit order try to execute that for us. Now, I want to say typically that happens, but there can be times when maybe the system misses it. Maybe the market's moving really, really swiftly, and sometimes it might not get executed. So still keep an eye on it when it gets out there so that you know that it really has executed. Now, something that I find interesting today, we've got CTSH. And this is a little bit newer of a trade for us. I want to do something with it here. We got in a couple of weeks ago. This had broken down below a support area, and we were trading it bearishly as well. You can see here I've outlined we had an 82 short call, 8250 I should say, 8250 short call vertical. It expires in 2 weeks, April 17th. Well, it's been dropping down here, and today, of course, it dropped, and it got clear down here. And it wasn't taking my order, our order that we have sitting out there. Look at this with me. I'm going to open this up. You can see this is where our spread sits. And I want you to notice what we've got here in terms of values. 0 by 40. That is, we're seeing the volatility create wider spreads here for us. So earlier today, this was a 0.40 and this was a 0.30. Okay. And so basically it was saying, yeah, you've got your order sitting out there, but the spreads are extra wide right now, and it wouldn't execute the trade. In fact, if I went to the working orders here, and we'll see how much it's changed. In our working orders on CTSH down here, oh, it's still showing that. We're saying we are willing to get out at 16 cents, and the midpoint between the bid and the ask price is actually negative. You're like, why aren't you executing for me? And it's because both of those options, it's saying it just doesn't want to deal with us. All right. But it would be nice if we didn't have to sit there and wait on it, right? We don't want to necessarily wait 14 more days to get out of the trade. That's the 17th. Now it's in pretty good shape, and there may be some people who wouldn't mind sitting it out, right? Waiting a little bit longer. But there are others, folks, that say, you know what, if we've got a majority of the gain, let's just go change our order. We maybe aren't getting our 70% that we wanted, but let's go ahead and get out of the trade. So what we're going to do here is we're going to change our order. on this, we're just going to say cancel replace, and we're going to experiment a little bit here. Hopefully it'll work pretty quickly for us. We're going to go up to 20 cents. Let's see if we say we'll buy it back for a little bit more, if it will execute for us. Now we'll see it if it does execute right here, we'll see it pop up. Now it didn't do it immediately, so that might mean we have to go back again and do it one more time. While we're here together, I'll do it one more time, okay? Let's maybe go up another nickel. All right, we'll do cancel replace. Let's go up to 25 cents. Maybe that will be enticing enough. We would hope so, that it will get us out of the trade. If it doesn't by the end of the day, we won't be together here at the end of the day, but if it doesn't do it by the end of the day, what I may have to do is go in and kind of put in something even a little bit nicer, where we're still getting out of a pretty good chunk of the gain, right, that we started out with. But this can be one of the things that you encounter when we have more volatile markets and those spreads widen out. Now, True says, hey, you know, one thing we could do is just close one leg at a time. And that actually, since it didn't execute it, that might be very good to do. And what does that mean? It means, well, we'll just go buy back our short leg. And we'll leave our long leg to just sit there and execute. Let's try that. Show you how that would work. I'll come in here and do a new create closing order. And usually you'll pick this top one, okay? This is saying, oh, let's go back just buy back our short leg, not even both of them, for 25 cents. And this is saying they're not willing to give us anything for it. It's saying 0. Let's try that. Just get out of our obligation leg and let's just plan to let this long call just expire worthless. All right, let's try that. I like that idea. Let's see if it'll cooperate with us. And with our number of contracts, that ends up to be a little bit. My demo account doesn't charge commissions. Just know you will be charged commissions. Okay, sometimes it doesn't fill in there. So just kind of noticing that. All right, bingo, that worked. Truth, you get a gold star because, yeah, that's certainly a way to approach it as well. Very good. Well, you guys, we're out of time here. One of my objectives was to help you feel a little bit more comfortable with the risk profile tool, okay? We will visit it again on occasion. This isn't the only time that we're going to talk about it because it can be really helpful for those of you that are real visual learners, okay? Here's our position that we still have. This is our long call sitting here that it doesn't want to buy. We'll see what happens. Right? Maybe the market rallies and maybe it actually gains some value. Who knows? We'll pay attention to it. We won't just ignore it. All right. Now, do we have any kind of final questions as we wrap up here? We ended up putting in a couple of new bearish trades. We put in APP and AMD that both had bear flags that they were breaking out of. And then we followed up on some of our orders. Some went down, hit our targets. Our exits that we had already placed. Perfect. We love it when that happens. And some of them we're just going to have to let work a little bit more time. All right. Well, you guys, coming up next is going to be getting started with stock investing. That's going to be, I believe, with Kevin Horner. And so if we're feeling maybe a little bit more overwhelmed with this particular topic and you want something maybe a little bit just stock related, that's a fantastic class to go to. All right. Appreciate your input here today. Remember, subscribe, follow us. If you found this helpful today, there was not a survey out there. If you found this helpful, go ahead and hit the like button. That'll allow others to see that are looking for that type of information as well. And you do somebody else a favor. Brett, thank you for helping out in the chat. These guys kept you a little bit busy here today. All right, we'll follow up on these trades next week. We'll see you then. Bye-bye.